Did you know that 35% of Americans use TurboTax, 30% rely on an accountant, and the rest either handle it themselves, ask a friend, or don't file at all? When I first learned this, I couldn't help but wonder, how many people are leaving money on the table without even realizing it? By the end of this video, you'll know which option can save you the most money. After analyzing thousands of tax returns, I've uncovered patterns that reveal whether TurboTax or a CPA is the smarter choice for different income levels and life situations. Let's dive in. The TurboTax trap. That $40 TurboTax advertisement you keep seeing? It's probably going to cost you 3 times that amount by the time you actually file. Here's why that happens and what it means for your wallet. TurboTax markets itself as the simple, affordable solution for everyone. Free filing for basic returns sounds great, until you realize most people don't qualify for the free version. The advertised price is just the tip of the iceberg. Imagine this scenario. You start with the $40 plan, but then you need to file a state return, itemize deductions, or get help from a tax expert. Each of these adds another fee, and suddenly, what seemed like a budget-friendly option can easily climb past $180, or even over $300 for more complex returns. The bigger issue is what TurboTax might not catch. About 35% of DIY filers make costly mistakes, according to research. Some overlook credits like the Earned Income Tax Credit or deductions for student loan interest. Others misfile dependents or misreport gig income. One study found that TurboTax users missed an average of $460 in deductions per return, money that could have stayed in their pockets. Think of it like leaving cash on the table, because the software didn't flag something you didn't know to look for. Math errors are another common pitfall. The IRS reported nearly 2.5 million math errors on returns in a single year. While TurboTax helps with calculations, it's only as accurate as the information you provide. Enter the wrong number from a W-2 or miscategorize an expense, and the software might not catch it. This can lead to delays, audits, or even owing more than you should. Sure, e-filing has a lower error rate, less than 1% compared to paper returns 21%. But mistakes still happen, and they can be costly. Timing is another factor. People who rush to file early often realize they forgot a 1099 or received a corrected form later. Now they're stuck amending their return, which is a messy and time-consuming process. TurboTax makes it simple to file, but fixing errors? That's a different story. So who should use TurboTax? If you have a straightforward W-2, no dependents, and take the standard deduction, it's a decent option. But once you add rental income, freelancing, investments, or itemized deductions, the risk of missing something grows fast. Hidden fees and potential mistakes can turn what seemed like a convenient solution into a costly headache. CPA myths busted. Most people think CPAs are only for the rich, but that's not true. The average CPA fee is $323 for a basic return, far less than most imagine. And here's the kicker. They often uncover $1,000 plus in extra deductions, making their fee pay for itself. Let's break down when a CPA actually saves you money instead of costing you. Take Sarah, a freelancer juggling multiple income streams. She paid $192 extra to a CPA and discovered home office deductions, mileage write-offs, and retirement contributions she had overlooked. That one consultation saved her over $2,000 in taxes. One study found CPAs identify 20% more deductions than software. DIY filing often leaves real money on the table. The IRS reports taxpayers using professionals have lower audit rates. Why? CPAs catch errors before they're filed. TurboTax might ask if you had a home office, but a CPA calculates the exact square footage you can legally deduct. They'll dig into side gigs, rental income, or stock sales that software might gloss over. Small business owners especially benefit. If your business is a pass-through entity, every dollar saved counts. A CPA can strategize whether to accelerate or postpone income, optimize estimated tax payments, and navigate employee stock options. First-time business owners often miss thousands in write-offs, business mileage, equipment depreciation, even part of your phone bill. These strategies aren't in TurboTax's playbook. Parents can also gain from a CPA's expertise. The child tax credit is straightforward, but what about the dependent care credit if you hire a summer nanny? Or education credits if you're taking night classes? CPAs dig deeper than software checkboxes. ensuring you don't miss out on valuable credits. Timing is another area where CPAs shine. They don't just help at tax time. They can adjust your withholdings mid-year to avoid a surprise bill, warn you about required minimum distributions if you're nearing retirement, or flag if you're overpaying estimated taxes. This proactive planning is where software falls short. For investors, a CPA's expertise can be a game changer. Schedule D filers often pay $118 extra for CPA help, but the savings can be significant. A CPA knows cost basis rules, wash sale nuances, and how to offset gains with losses. TurboTax might calculate it correctly, but it won't suggest strategic moves like harvesting losses before year-end. Rental property owners also benefit. Schedule E filers paying $145 extra can deduct depreciation, maintenance, and even travel to manage properties. One landlord discovered he could deduct 14,000 miles driven for repairs, something TurboTax never prompted him to track. Life changes? A CPA has you covered. Got married? They'll run scenarios to see if filing jointly or separately saves more. Inherited money? A CPA knows state inheritance tax traps. These are the kinds of details software can't predict. Here's the tipping point. If your tax situation has just one complication, a house, freelance income, investments, a CPA often pays for itself. The National Society of Accountants found basic returns with itemizing average $323. Adding a Schedule C for business income costs $192 extra. That $515 total could easily uncover $2,000 plus in overlooked deductions. For many, the savings far outweigh the cost. The hybrid hack. You don't have to choose between TurboTax and a CPA. There's a smarter way to combine the best of both. Most people don't realize they can pair professional tax advice with DIY software to save money while still getting expert guidance. The key is knowing when to use each tool. The hybrid method starts with gathering all your tax documents, W-2s, 1099s, mortgage statements, and anything else relevant. Next, schedule a consultation with a CPA. For about $150 to $300, they'll review your documents, identify deductions, and flag potential audit risks. This upfront investment often pays for itself in uncovered deductions alone. Afterward, you use TurboTax to prepare and file your return, applying the CPA's insights. Here's an example. Imagine you're a freelancer who just started earning side income. You gather your income records, receipts for business expenses, and any other relevant paperwork. During your CPA consultation, they point out deductions you didn't know about, like home office expenses or mileage. They also warn you about common mistakes freelancers make, like misreporting 1099 income. Armed with this advice, you confidently complete your return in TurboTax, saving hundreds compared to full CPA preparation. This approach solves two major problems with DIY filing. First, tax software asks generic questions that might not fit your situation. A CPA, on the other hand, tailors their advice to your specific financial picture. Second, TurboTax doesn't offer strategic guidance for future tax planning. A CPA can suggest moves like increasing retirement contributions or timing capital gains to lower next year's bill. The hybrid method is especially useful for people with moderately complex taxes. If you have rental property, freelance income, or investments, you likely need more help than TurboTax alone provides, but don't require full-service CPA preparation. Studies show taxpayers using this approach save an average of $470 compared to full CPA services, while still catching most deductions. Business owners benefit significantly from this model. A CPA can explain how to categorize expenses, depreciate equipment, or write off vehicle use. Then, you enter everything correctly in TurboTax, cutting the CPA's time, and your bill, in half. Another option is using TurboTax first, then having a CPA review your completed return before filing. Many CPAs offer this service for $100 to $200. They'll catch errors and missed opportunities without redoing all the work, ensuring accuracy while keeping costs low. Life changes like getting married, having a child, or buying a house are perfect triggers for hybrid help. A one-time consultation explains how these events affect your taxes long-term, so you can handle future filings with confidence. Similarly, investors can avoid costly mistakes by consulting a CPA about wash sale rules or offsetting capital gains with losses, then applying that advice in TurboTax. One overlooked benefit of this approach is the learning opportunity. Working with a CPA first helps you understand why certain deductions apply, building your confidence for future filings. Timing is key. Schedule your CPA consultation early in the year, before tax season gets busy, to ensure you have time to implement their advice. For gig workers, the hybrid method is a game changer. Many don't realize they can deduct mileage, home office space, or equipment until a CPA points it out. Once you learn these rules, you can apply them yourself year after year. The sweet spot for hybrid savings is household incomes between $60,000 to $150,000. Below that range, TurboTax alone might suffice. Above it, full CPA preparation often makes sense. But in the middle, combining both services optimizes value while uncovering unexpected benefits, like better audit protection and smarter long-term planning. Income level secrets. Your income level determines more than just your tax bracket. It shapes whether TurboTax or a CPA is the smarter choice for you. The wrong decision could cost you thousands. So let's break it down by income level and see how these differences impact your tax filing strategy. If you earn under $50,000, TurboTax is usually the way to go. At this income level, your tax situation is likely simple. Think W-2 income, the standard deduction, and maybe a few common credits like the Earned Income Tax Credit. For example, Sarah, a retail worker earning $40,000, uses TurboTax to file her taxes. Her refund averages $1,800, and hiring a CPA would cost her at least $300, eating into her refund unnecessarily. The IRS reports that 72% of filers in this bracket take the standard deduction, so itemizing rarely makes sense. TurboTax handles these straightforward returns well, making it the most cost-effective option. Between $50,000 and $100,000, things start to get more complex. Let's say John, a teacher earning $65,000, recently bought a home and started investing. His tax situation now includes mortgage interest, property taxes, and potential capital gains. While TurboTax can handle these, a 1-hour CPA consultation costing $150 to $300 could uncover deductions he might miss, like charitable contributions or energy-efficient home upgrades. IRS data shows that filers in this range using professionals find an average of $1,200 more in deductions compared to software users. A hybrid approach, consulting a CPA for advice, then filing with TurboTax, can strike the perfect balance between cost and accuracy. At $100,000 to $200,000, the scales tip toward hiring a CPA. For instance, Maria, a freelance graphic designer earning $120,000, faces a 24% tax bracket and must navigate long-term capital gains rates, which shift from 0% to 15% in this range. Missing deductions like home office expenses or retirement contributions could cost her thousands. The average CPA fee of $323 often pays for itself quickly at this level. Studies show that filers in this bracket save an average of $2,400 more with a CPA than with software alone. Over $200,000, a CPA becomes essential. Consider James, a tech executive earning $250,000. He faces the 3.8% surtax on investment income, potential AMT exposure, and the loss of the standard deduction. A CPA can help him time income to avoid bracket creep, maximize retirement contributions, and navigate complex deductions. Audit rates also increase significantly at this level, making professional preparation a smart defense. Business owners have their own tipping points. Once your side hustle earns over $5,000 in net profit, the tax code gets tricky. For example, Lisa, who runs an online store, saves $5,000 annually by working with a CPA to properly deduct expenses like mileage, home office space, and equipment depreciation. TurboTax might ask about these expenses, but won't guide you on how to maximize them legally. Retirees face unique challenges too. When you start taking required minimum distributions, RMDs, withdrawals count as income and can push you into a higher bracket. A CPA can help strategize Roth conversions or qualified charitable distributions to minimize the tax hit. For example, delaying certain withdrawals could keep you below the 20% long-term capital gains threshold. Finally, homeowners should reassess their approach after buying. Mortgage interest and property taxes often make itemizing worthwhile, but only if done correctly. The average homeowner misses $3,500 in deductions during their first year, such as points paid at closing or energy-efficient upgrades. A CPA ensures you don't leave money on the table. Life changes that change everything. Here are 5 life events that should make you immediately switch how you file your taxes. Most people don't realize these changes can completely alter what deductions and credits you qualify for, and sticking with your old filing method could cost you thousands. 1. Getting married. Imagine tying the knot and assuming filing jointly is always the best option. That's not always true. If one spouse has student loans, medical expenses, or a significantly lower income, filing separately might save you money. For example, income-driven repayment plans for student loans are recalculated based on joint income, potentially doubling payments. A CPA can compare both filing methods to determine which saves you more overall, something tax software can't do automatically. 2. Buying a home. Picture buying your first home and missing out on $3,500 in deductions your first year. Mortgage interest, property taxes, and points paid at closing are just the beginning. Many new homeowners don't realize they can also deduct home office space if they freelance or claim credits for energy-efficient upgrades like solar panels. A professional can help you navigate these deductions and ensure you maximize your savings. 3. Having a child. Think about welcoming a new baby and leaving money on the table because you didn't adjust your filing method. The child tax credit is well known, but many parents overlook the child and dependent care credit for daycare expenses or deductions for education savings plan contributions. The IRS reports that 40% of eligible families miss out on the full child tax credit, which could mean losing up to $2,000 per child. A CPA ensures you claim every dollar you're entitled to. 4. Retirement. Imagine retiring and being hit with an unexpected tax bill when you start taking required minimum distributions, RMDs. Many retirees don't realize they could strategically convert traditional IRA funds to Roth accounts during low-income years to reduce their tax burden. For instance, crossing the $533,400 threshold for long-term capital gains could trigger a 20% tax rate. A CPA can help you plan ahead to avoid these costly surprises. 5. Inheriting money. Picture inheriting a traditional IRA and being required to withdraw all funds within 10 years, creating a massive tax bill. The average inheritance triggers $12,000 in unexpected taxes, and different assets, like retirement accounts, property, and investments, have unique tax treatments. A CPA can help you spread out distributions to minimize the hit and avoid costly mistakes, especially for inheritances over $50,000. Each of these life events introduces complexities that tax software often can't handle effectively. Professional guidance ensures you don't miss out on valuable deductions and credits, saving you money in the long run. Audit Protection Showdown. TurboTax's audit protection sounds great in the commercials, but there's a catch they don't tell you about. That extra $60 you pay for their audit defense service comes with serious limitations. It only covers basic correspondence audits, the kind where the IRS sends a letter asking for more documentation. If your audit escalates to an in-person meeting or field examination, TurboTax's protection often falls short. They'll help prepare documents, but you're largely on your own when facing an IRS agent. Now, imagine the anxiety of sitting across from an IRS auditor, trying to defend your tax return without professional support. This is where CPAs make all the difference. When you hire a professional, you're not just paying for tax preparation, you're securing peace of mind. A CPA will attend every meeting with the IRS on your behalf, armed with the expertise to navigate the process. They know exactly what documentation to provide, what to withhold, and how to handle the situation to minimize stress and risk. More importantly, they can often prevent audits from happening in the first place by filing returns that avoid red flags. The numbers back this up. IRS data shows self-prepared returns have a 0.5% audit rate, while CPA-prepared returns sit at just 0.2%. That means DIY filers are 2.5 times more likely to get audited. For business owners, the gap is even wider. Schedule C filers using TurboTax face a 1.4% audit rate compared to 0.7% with a CPA. And for high-risk categories like those claiming the earned income tax credit or reporting over $100,000 in business income, the stakes are even higher. TurboTax's basic protection simply doesn't measure up. Here's the critical difference. TurboTax won't negotiate with the IRS on your behalf. If an auditor questions your home office deduction, TurboTax can't argue why it's legitimate. A CPA can. TurboTax also won't spot potential audit triggers in your return before you file. A CPA reviews every number with an eye toward what might draw IRS attention. And if things go really wrong, TurboTax won't represent you in tax court. A CPA will. The cost comparison might surprise you. TurboTax's full audit defense package runs about $60 to $100 per year. A CPA might charge $300 to $500 to prepare your return, but that includes built-in audit protection. When you consider that CPA-prepared returns are audited less often and yield better outcomes when they are, the price difference shrinks fast. In fact, taxpayers with professional representation pay 40% less in additional taxes after audits than those who go it alone. Business owners, in particular, need real audit protection. The IRS scrutinizes cash businesses, independent contractors, and anyone claiming large deductions relative to income. TurboTax might ask if you have documentation for those meal expenses, but a CPA will tell you exactly what receipts the IRS expects. They'll also advise on what percentage of your phone bill you can legally deduct as a business expense, something software can only guess at. Investment income adds another layer of complexity. If you trade stocks or crypto, the IRS gets copies of all your 1099s. TurboTax will import them, but it won't warn you if your cost basis looks suspiciously low. A CPA knows how to properly report wash sales, foreign tax credits, and other complex scenarios that can trigger audits. They'll also help you strategize capital gains harvesting to minimize future risks. The biggest limitation of TurboTax's audit protection? It doesn't cover user errors. If you forget to report a 1099 or claim a deduction you're not entitled to, that's on you. TurboTax's terms explicitly state they're not responsible for incorrect inputs. A CPA, on the other hand, is legally liable for mistakes they make in preparing your return. That professional responsibility means they double-check everything in ways software can't. When it comes to audits, the stakes are high. The stress, the potential financial fallout, and the time spent dealing with the IRS can be overwhelming. A CPA doesn't just prepare your taxes. They protect you from the worst-case scenarios. TurboTax might be fine for simple returns, but when the IRS comes knocking, you'll want a professional in your corner. Time versus money equation. Here's how to calculate whether your time or money matters more when filing taxes. Imagine tackling a home project like painting a room. Sure, you could do it yourself, but how much time will it take? And is it worth hiring a pro to save that time? Filing taxes works the same way. Most people only compare the cost of hiring a CPA versus using TurboTax, but they often overlook the hours they'll spend doing their own taxes. Let's break it down. The IRS estimates it takes 13 hours on average to file Form 1040 yourself. That includes 6 hours for record keeping, 2 for tax planning, 4 to complete the forms, and 1 for other tasks. For business owners, it's even more, 22 hours total, with 12 hours just for record keeping. Multiply those hours by your hourly rate, and the numbers can be surprising. Here's a simple formula. Hourly rate times time spent on taxes equals your time cost. If that number is higher than a CPA's fee, hiring help makes sense. For example, if you earn $50 per hour and spend 10 hours on taxes, that's $500 of your time. With the average CPA fee at $323, you'd save $177 by hiring one. TurboTax might seem cheaper upfront, but the time cost changes the equation. Say you spend 15 hours learning the software, entering data, and fixing mistakes. At $25 per hour, that's $375, more than the $323 average CPA fee. Even at $15 per hour, 15 hours equals $225, which is close enough to make professional help worthwhile. The complexity of your taxes also matters. A simple W-2 return might take 5 hours, $125 at $25 per hour. But add investments, rental properties, or self-employment income, and those hours skyrocket. Business taxpayers average 22 hours, which at $50 per hour equals $1,100, far more than a CPA's fee. Mistakes add hidden time costs. The IRS reports 2.5 million math errors annually. Fixing them means amendments, calls with the IRS, and hours of follow-up. A CPA reduces this risk by catching errors before filing and handling IRS notices. Some argue they'll spend time gathering documents for a CPA anyway. True, but organizing receipts takes about 2 hours for a professional versus 6 for a DIY filer. CPAs know exactly what they need, while software users waste time figuring it out. Tax planning tips also tilt the scales. TurboTax only helps after the year ends, when it's too late to make changes. A CPA uses those 2 planning hours to suggest moves like increasing retirement contributions or timing stock sales, saving you money now, not just reporting what already happened. Business owners especially should run the numbers. 12 hours of record keeping at $75 per hour is $900 before filing even starts. The average Schedule C fee is $192, clearly worth it when your time costs nearly 5 times that. Plus, CPAs often find more deductions, paying for themselves twice over. Your hourly rate determines the smart choice. Below $20 per hour, DIY might make sense for simple taxes. Between $20 to $50 per hour, weigh your situation carefully. Above $50 per hour, a CPA almost always saves you money. Entrepreneurs and high earners cross this threshold quickly. Some say they do taxes during evenings or weekends when they wouldn't be working anyway. But what's your free time worth? Relaxation, family, or side projects might be a better use of those hours. Unless you genuinely enjoy tax prep, is it worth the trade-off? Finally, think long-term. Once a CPA knows your finances, future years take less time and cost less. They already understand your business structure, investments, and deductions. DIY filers start from scratch every year. So what's your time worth? Whether it's saving hours, the deduction detectives. TurboTax asks the obvious questions, but tax professionals act like deduction detectives, uncovering hidden treasures that software often misses. The average TurboTax user overlooks 3 to 5 deductions they could have claimed, according to IRS data. That's real money left on the table because software can't think like a human accountant. Let's follow the trail of deductions that slip through TurboTax's cracks, but CPAs catch every time. Take home office deductions, for example. TurboTax might ask if you have a home office, but it won't guide you through the best way to calculate it. The simplified method allows $5 per square foot up to 300 square feet, but the actual expense method often yields bigger savings. A CPA knows to include portions of your utilities, internet bill, and even home repairs. The IRS reports only 35% of eligible taxpayers claim this deduction, leaving thousands unclaimed each year. Education credits are another area where CPAs shine. The Lifetime Learning Credit offers 20% of the first $10,000 in education expenses, up to $2,000 per return. Many TurboTax users miss this because they don't realize it applies to part-time students, graduate programs, or even single courses to improve job skills. CPAs dig deeper, asking about all education expenses, not just full-time tuition. Research shows taxpayers using professionals claim 20% more education benefits than DIY filers. Energy-efficient home improvements are a hidden gold mine. The Residential Clean Energy Credit covers 30% of costs for solar panels, geothermal heat pumps, and battery storage systems. TurboTax might not prompt you to look for Form 5695 unless you already know about it. A CPA, on the other hand, will ask if you've made any green upgrades to your home. The average credit here is $1,200, often enough to cover the CPA's fee. Medical expense deductions are another tricky area. You can deduct expenses exceeding 7.5% of your adjusted gross income, but many filers forget what qualifies. Mileage to doctor appointments, home modifications for disabilities, and even travel expenses for medical care all count. CPAs know to ask about these less obvious costs. The IRS found only 12% of eligible taxpayers claim medical deductions, leaving an average of $1,800 unclaimed. Charitable contributions often go underreported. TurboTax asks about cash donations but might miss non-cash items like clothing, household goods, or even mileage for volunteer work. A CPA ensures you account for all forms of giving and have proper documentation to avoid audit triggers. For self-employed filers, the stakes are even higher. Health insurance premiums, retirement contributions, and home office equipment often go unclaimed. TurboTax asks about business expenses, but won't suggest strategies like bunching deductions into high-income years. CPAs uncover an average of $5,000 more in deductions for small business owners compared to software. Finally, investment-related deductions are another blind spot. TurboTax imports your 1099s, but won't explain tax loss harvesting opportunities. A CPA can spot when selling losing positions could offset gains and ensure you properly report wash sales, a common audit trigger when done wrong. Each deduction a CPA uncovers adds up, creating a cumulative impact that can save you thousands. While TurboTax follows a script, CPAs act like sleuths, piecing together the clues to maximize your return. Business owner breakdown. If you're running a business, even a tiny side hustle, you're playing in a whole different tax league. The average small business overpays $5,000 every year by using TurboTax instead of hiring a CPA. That's because tax software often misses the nuances of business-specific deductions and strategies. Let's start with equipment purchases. TurboTax might ask if you bought business equipment, but it won't guide you through the best way to write it off. A CPA, on the other hand, evaluates options like Section 179 deductions, bonus depreciation, or the straight-line method to maximize your savings. For example, a $2,000 laptop could be fully deductible this year or spread over 5 years. Choosing the right method depends on your income now and your projections for next year. Home office deductions are another area where business owners lose out. TurboTax offers the simplified method, $5 per square foot, but the actual expense method often saves more. A CPA calculates the percentage of your mortgage interest, utilities, and even home repairs that qualify. The IRS reports only 35% of eligible business owners claim this deduction, meaning most leave money on the table because software doesn't ask the right follow-up questions. Vehicle expenses can also get tricky. TurboTax might ask about mileage, but won't help you decide if actual expenses, like gas, repairs, and insurance, would save you more. Plus, if you use the same car for both personal and business purposes, you need to track usage precisely. A CPA ensures you're compliant and getting the maximum deduction. Take the case of Sarah, a freelance graphic designer. She initially used TurboTax and missed out on thousands in deductions for her home office and vehicle expenses. After hiring a CPA, she learned how to properly allocate her expenses, saving over $4,000 in taxes that year alone. Stories like Sarah's highlight the real-world impact of professional guidance. Retirement contributions are another blind spot for self-employed individuals. TurboTax won't explain how a solo 401k could let you contribute up to $69,000 in 2024 if structured correctly. A CPA compares options like solo 401k, and SEP IRAs to find the one that reduces your taxable income the most while setting you up for the future. Payroll taxes are a common pitfall for small businesses. If you have employees, or even just pay yourself from an LLC, there are specific forms and deadlines to follow. Missing a payroll tax deposit by even one day can result in penalties of up to 15%. A CPA keeps you compliant and helps reduce what you owe. Business structures are another area where CPAs shine. That LLC you set up on LegalZoom? A CPA can analyze whether filing as an S-Corp could save you thousands in self-employment taxes once your profit hits $60,000 or more. TurboTax won't help you determine if the extra paperwork is worth it. Finally, inventory-based businesses face unique challenges. If you sell products, choosing the right inventory accounting method, FIFO, LIFO, or average cost, can significantly impact your taxable income. A CPA helps you select the method that keeps more money in your pocket. Here's the bottom line. Once your business nets $5,000 annually, a CPA pays for itself. The average fee for Schedule C preparation is $192, far less than the $5,000 most small businesses overpay. And if you're spending more than 10 hours a year wrestling with taxes, that's time better spent growing your business. The free file loophole. Most people don't realize they could be saving hundreds of dollars by filing their taxes for free. The IRS Free File program allows taxpayers with incomes under $79,000 to file federal returns at no cost through partner software companies. Yet, only 2% of eligible Americans take advantage of it. That means millions are unnecessarily paying TurboTax or H&R Block 40 to $120 for something they could get for free. Here's who qualifies. For 2024 taxes, the income limit is $79,000 adjusted gross income, which covers about 70% of American taxpayers. Self-employed individuals are also eligible as long as their adjusted gross income, after business deductions, falls under the limit. For example, if you made $90,000 but had $15,000 in business expenses, you'd still qualify. Many freelancers and gig workers miss this and end up paying for software they don't need. The process is simple. The IRS partners with 8 major tax prep companies to offer free versions of their software. These aren't stripped-down tools. They're the same programs people pay for, just with income restrictions. Each company sets its own rules within the $79,000 ceiling. For instance, TaxAct's free version covers incomes up to $65,000, while H&R Block's goes all the way to $79,000. The key is to access the software through the IRS Free File portal, not the company's main website, where they'll try to upsell you. State returns can be a bit trickier. While federal filing is free, some states charge for state returns. However, 22 states, including California, New York, and Texas, have their own free file programs. If you qualify for the federal program, you may also qualify for free state filing. Just make sure to look for the option when completing your federal return. The IRS Direct File program is another free option, but it's more limited. It's only available in 12 pilot states and is designed for people with simple W-2 income who claim the standard deduction. It doesn't support itemizing or business income, so for most taxpayers, the Free File program through private software offers more flexibility. Using Free File doesn't mean sacrificing features. You'll still need your W-2s, 1099s, and deduction records, and the software supports document uploads and automatic data imports from employers and banks. The main difference? You're not paying $60 or more for the same functionality. Audit protection is one area where Free File differs. Most free programs don't include audit defense. However, the IRS reports that Free File users have lower error rates than paper filers or even paid software users, thanks to built-in error checks. Military members get special benefits. Through the MilTax program, all active duty personnel, including reservists and National Guard, qualify for free filing regardless of income. Even if you're deployed and earning $100,000, you can file for free. Unfortunately, many service members aren't aware of this and end up paying unnecessarily. Retirees and students also benefit. Social Security counts toward the $79,000 limit, but many retirees stay under that threshold. Students can claim education credits, like the American Opportunity Tax Credit and Lifetime Learning Credit, without paying for software. Even graduate students with part-time jobs often qualify. The key to saving money is starting at the IRS Free File website. If you go directly to a company's main site, they'll steer you toward paid products. The IRS portal ensures you access the truly free versions. It might take an extra click or two, but it's worth it to avoid spending money unnecessarily. The IRS estimates the average taxpayer spends $140 on tax prep annually. Over a decade, that's $1,400 wasted. The Free File program exists to help middle-income filers avoid these costs. Yet only 3 million people used it last year out of 100 million who qualified. Don't leave money on the table. Take advantage of what's already available to you. Year-round tax strategy. That tax refund you're excited about in April? Think of it like spilling water on the table. It's money you could have kept flowing into your pocket all year. The average refund is $3,000. That's $250 per month you could have used instead of letting the government hold it interest-free. Your filing method right now is setting up next year's paycheck withholdings, whether you realize it or not. TurboTax might get your return filed, but it won't optimize your year-round tax strategy like a CPA can. Here's how it works. When you file your taxes, you're setting the baseline for next year's withholdings. The IRS uses this year's numbers to calculate how much tax should come out of each paycheck starting in January. If you get it wrong, You'll either owe a surprise bill next April or keep overpaying all year. TurboTax asks basic W-4 questions but can't analyze your full financial picture. A CPA looks at your entire situation to adjust withholdings precisely. Withholding calculations make all the difference. The IRS reports that 73% of taxpayers get refunds, meaning most people overpay all year. TurboTax's withholding calculator is better than nothing, but it misses key details. For example, if you got a raise mid-year, started a side hustle, or bought rental property, software won't properly adjust for these changes. A CPA runs projections based on your actual expected income, not just last year's numbers. Take Sarah, for example. She got a promotion in June and had her first child in July. By working with a CPA, she adjusted her withholdings mid-year to reflect her higher income and new child tax credit. Instead of waiting for a big refund, she saw an extra $400 in her monthly paycheck for the rest of the year. Money she used to cover daycare costs immediately. Quarterly estimated taxes are where business owners really need help. TurboTax can calculate what you owe, but it won't warn you about underpayment penalties before they happen. The IRS charges 8% interest on underpaid taxes. That adds up fast. A CPA monitors your income throughout the year and adjusts payments accordingly. They'll tell you in September if you need to increase Q4 payments, not wait until April when it's too late. Investment income creates another wrinkle. Capital gains, dividends, and interest often aren't subject to withholding. TurboTax might tell you owed tax on investments after the fact, but a CPA helps plan for it up front. They'll suggest increasing paycheck withholdings or making estimated payments to cover investment taxes before they're due. This prevents that nasty April surprise when your $5,000 stock sale triggers a $750 tax bill you didn't expect. Life changes mid-year really throw off withholdings. Got married in September? TurboTax won't help you adjust withholdings mid-year to account for this. A CPA recalculates your optimal withholding immediately after major life events. That new baby could mean an extra $2,000 child tax credit next year. Why wait until April to benefit when you could adjust withholdings now? The IRS withholding estimator is free but limited. It only looks at W-2 income. If you have freelance work, rental income, or investments, it can't help. A CPA builds a custom model incorporating all income sources. They'll even account for state taxes, something the IRS tool completely ignores. Here's what most people miss. Optimal tax payments mean owing or getting back less than $1,000. The average refund is $3,000 because people either fear owing or don't understand withholdings. TurboTax can't coach you through this. It just processes what you tell it. A CPA explains how to adjust your W-4 to hit that sweet spot where you keep more money each paycheck without owing penalties. The student loan factor. Student loans affect more than just your monthly budget. They can completely reshape your tax strategy. Take Sarah, for example. She was on an income-driven repayment, IDR, plan and thought she had everything under control. But when she filed her taxes, she was blindsided by a higher-than-expected bill because she didn't realize how her filing status impacted her payments. Stories like Sarah's highlight why understanding the connection between student loans and taxes is so critical. IDR plans create a unique tax challenge. Your monthly payment is tied to your adjusted gross income, AGI, and the way you file your taxes directly affects that number. For married couples, filing jointly can double IDR payments compared to filing separately. TurboTax processes the numbers you input, but it won't analyze which filing status saves you more overall. A CPA, on the other hand, runs both scenarios to find the balance between lower payments and higher tax bills. Making the wrong choice here could cost you thousands each year. The student loan interest deduction, while seemingly simple, adds another layer of complexity. You can deduct up to $2,500 from your taxable income, but the benefit phases out for single filers earning between $75,000 and $90,000 AGI. TurboTax calculates this if you enter your 1098-E form, but it won't suggest strategies to stay under the threshold. A CPA might recommend increasing 401k contributions or harvesting investment losses to lower your AGI. That $2,500 deduction could save you $550 in taxes if you're in the 22% bracket, enough to offset part of a CPA's fee. Public Service Loan Forgiveness, PSLF, adds even more complexity. After 10 years of qualifying payments, your remaining debt is forgiven tax-free, but only if you're on the right repayment plan. TurboTax can evaluate whether switching to an IDR plan now will save you more in the long run. A CPA looks at your loan balance, income trajectory, and career path to determine if PSLF is worth pursuing or if aggressive repayment would cost less overall. This kind of long-term planning is where software often falls short. Forgiven debt under standard IDR plans becomes taxable income, which can lead to a financial shock. If $50,000 is forgiven after 20 years, that's $50,000 added to your taxable income in 1 year. TurboTax will report it, but it won't help you prepare for the tax hit. A CPA can create a strategy years in advance, such as suggesting Roth conversions or other moves to minimize the impact. Married borrowers face especially tricky decisions. Filing jointly often lowers your tax bill, but can increase IDR payments by including both incomes. Filing separately protects the lower-earning spouse's payment, but might disqualify you from other tax benefits. TurboTax processes what you input, but a CPA compares the combined cost of higher payments versus higher taxes to find the optimal path. State taxes and side hustles further complicate things. Some states tax forgiven student loans, even if the federal government doesn't, and side income increases your AGI, raising your IDR payment. TurboTax reports the numbers, but a CPA helps structure your finances to minimize both taxes and loan payments. For borrowers like Sarah, the crossover point where a CPA pays for itself is often lower. Once you owe $30,000 or more in student debt or are on an IDR plan, professional help typically saves more than it costs. The average CPA finds $1,200 in additional deductions, more than enough to cover their fee while optimizing your loan payments. The side hustle switch. That side hustle you started for extra cash? It might have felt like a small step, but it just changed your entire tax situation. Take Sarah, for example, a freelance designer who thought she had her taxes under control with TurboTax. She didn't realize she was missing out on $1,500 in deductions until she switched to a CPA. Stories like hers are common, and most gig workers don't realize they've crossed a threshold where DIY software falls short. Here's how to know when it's time to make the switch. The first red flag is hitting $5,000 in side income. That's when the IRS starts paying closer attention, and your tax situation becomes more complex. Gig workers at this level often miss key deductions like home office expenses. TurboTax offers the simplified method, $5 per square foot, but the actual expense method often saves more by factoring in rent, utilities, and internet. Mileage and vehicle costs. Whether it's 67.5 cents per mile in 2025 or actual expenses like gas and repairs, a CPA ensures you're maximizing deductions while properly tracking personal versus business use. Equipment and supplies, from packaging materials for Etsy sellers to tools for freelancers, these deductions often go unnoticed. Quarterly estimated taxes trip up nearly 40% of side hustlers. When taxes aren't withheld from gig income, the IRS expects payments every 3 months. TurboTax calculates what you owe, but doesn't warn you about underpayment penalties, which come with 8% interest. A CPA helps you avoid this by adjusting payments as your income fluctuates, saving you from costly surprises. Multiple income streams create another headache. That $3,000 from freelancing, $2,000 from Uber, and $1,000 from selling crafts? TurboTax imports the 1,099s, but doesn't strategize how to offset this income with deductions. A CPA looks at your full financial picture, spotting opportunities like bunching deductions into high-income years or maximizing write-offs across all gigs. The audit risk also jumps as your side hustle grows. Schedule C filers using TurboTax face a 1.4% audit chance versus 0.7% with a CPA. If you do get audited, TurboTax's protection won't help when the IRS questions why you claimed 80% business use of a vehicle you drive every weekend. A CPA ensures your claims are airtight, reducing both risk and stress. Retirement contributions are another blind spot. TurboTax won't tell you that a solo 401k lets you contribute up to $69,000 in 2024 if structured correctly. A CPA runs the numbers to show whether a solo 401k or SEP IRA cuts your tax bill the most, helping you plan for the future while saving now. Finally, receipt tracking overwhelms most gig workers. TurboTax doesn't teach you how to organize expenses properly for an audit. A CPA shows you exactly what to keep, like digital copies of receipts and mileage logs. And for how long, saving hours of scrambling if the IRS comes knocking. The $5,000 threshold isn't arbitrary. It's where most people's tax situations outgrow software. Below that, TurboTax might suffice. Above it, the average CPA finds $1,200 plus in additional deductions, more than covering their $300 average fee. For Sarah, switching to a CPA didn't just save her the homeowner advantage. Buying your first home. Congratulations, this is a huge milestone. But it's also like stepping into a maze of new tax rules, with hidden twists and turns that can cost you thousands if you're not careful. The same TurboTax software that worked fine for your apartment days might now leave serious money on the table. The average homeowner misses $3,500 in housing deductions simply because they don't know what to look for. Let's break down the key changes and why sticking with your old filing method could be a costly mistake. Mortgage interest is one of the biggest deductions for homeowners, but are you claiming it correctly? Those January mortgage statements show last year's interest, but missing even 1 month's detail could cost you hundreds. A CPA cross-checks everything against your Form 1098 to ensure you're claiming every penny. Refinanced your mortgage? There's deductible interest hidden in those closing costs that software often overlooks. Property taxes come with a cap. The SALT deduction limits you to $10,000 total for state and local taxes. While TurboTax applies this cap, it won't strategize how to work within it. A CPA might suggest bundling payments, like paying 2 years' property taxes in 1 year, to maximize your deductions. This alternating strategy can save thousands over time, something software can't plan for. Private mortgage insurance, PMI, is another deduction many miss. If your down payment was less than 20%, you're likely paying PMI, which is deductible if your AGI is under $100,000. TurboTax might ask about PMI, but won't explain the phase-out rules. Missing this deduction could mean leaving up to $2,500 on the table annually until you hit 20% equity. Home office deductions can feel like navigating a labyrinth. The simplified method, $5 per SQ feet, is easy but often shorts you. A CPA calculates actual expenses, the percentage of utilities, internet, and even home repairs tied to your workspace. The IRS reports only 35% of eligible taxpayers claim this properly, often because they don't know how to document it audit-proof. Energy-efficient upgrades are another area where homeowners lose out. That $15,000 solar panel system qualifies for a 30% tax credit. That's $4,500 back. Energy-efficient windows and HVAC systems also qualify, but TurboTax won't proactively flag Form 5695 unless you know to look. The average homeowner misses $1,200 in energy credits simply because they don't know these deductions exist. First-time homebuyers often fall into what professionals call the first-year tax trap. Closing costs contain deductible items like prepaid interest and property taxes, but they're buried in paperwork. Points paid to lower your interest rate are deductible too, often worth $1,000 plus on day one. TurboTax imports your forms, but won't explain how to parse these details. Renting out part of your home? That changes the game. A finished basement rented out might be miscategorized as passive income instead of active rental business income. A CPA ensures proper treatment, critical because passive losses have stricter deduction limits. One client discovered she could deduct 40% of her home's depreciation after 3 years of missing it. The biggest mistake new homeowners make? Sticking with the standard deduction. Once you own a home, itemizing often saves more, but only if you do it right. The IRS reports 90% of homeowners with mortgages should itemize, yet 35% still take the standard deduction because software doesn't explain the switch properly. Navigating homeownership taxes can feel overwhelming, but with the right guidance, you can turn this maze into a clear path to savings. A CPA acts like your personal guide, ensuring you don't miss a single opportunity to maximize your deductions. The marriage math. Getting married changes everything about your taxes, and most couples don't realize how much their filing status impacts their finances. Take Sarah and Mike, for example. Sarah earns $150,000 a year, while Mike makes $40,000. They assumed filing jointly was the best option, but after consulting a CPA, they discovered they were paying an extra $1,800 in taxes due to the marriage penalty. Here's how marriage changes your tax situation and why professional help can save you money. 1. Filing status matters. The biggest mistake newlyweds make is defaulting to married filing jointly without exploring alternatives. While this option is simpler, it's not always the most cost-effective. For couples like Sarah and Mike, filing jointly pushed some of Mike's lower income into higher tax brackets, increasing their overall tax burden. Filing separately kept their incomes in their respective brackets, saving them money. Software like TurboTax processes numbers, but doesn't compare scenarios side by side. A CPA, however, runs parallel calculations to determine the best approach. 2. Student loans. If one spouse has student loans under an income-driven repayment plan, filing jointly can cause payments to skyrocket. For instance, Sarah's $300 monthly payment could jump to $700 because joint income recalculates repayment thresholds. A CPA evaluates whether the tax savings from filing jointly outweigh the increased loan payments, something tax software doesn't account for. 3. Medical expenses. Medical deductions are another area where filing separately can help. You can only deduct expenses exceeding 7.5% of your adjusted gross income. If Mike had significant medical bills, filing separately might allow him to meet the threshold, while filing jointly could make it impossible. Tax software processes deductions, but doesn't strategize like this. 4. Itemized deductions. Filing separately can also unlock benefits for itemized deductions. If one spouse has substantial deductions, such as charitable contributions or medical expenses, filing separately ensures those deductions aren't diluted by the other spouse's income. The IRS reports couples save an average of $1,200 when this strategy is used correctly. 5. State taxes and community property laws. For couples in community property states, income is divided equally between spouses for tax purposes. While TurboTax handles this mechanically, it doesn't explain how to optimize federal and state returns. A CPA coordinates these filings to maximize savings. 6. Retirement contributions. Marriage also impacts retirement planning. For example, if Mike doesn't work, Sarah can contribute up to $7,000 to a spousal IRA, but only if they file jointly. While TurboTax allows the contribution, it doesn't explain how filing status affects long-term retirement strategies. 7. Audit risks and withholding adjustments. Marriage shifts audit risks, especially for couples with one high-income earner and one with business losses. A CPA structures filings to minimize red flags. Additionally, estimated tax payments often need adjusting after marriage. If both spouses were paying separately, their combined withholding might now be incorrect. A CPA ensures W-4s are updated to avoid penalties. 8. Tax credits. Finally, tax credits like the Earned Income Tax Credit and Child Tax Credit phase out based on joint income. Filing separately might preserve eligibility for these credits, but only a CPA can weigh the trade-offs effectively. Marriage changes your tax landscape in ways software can't fully address. Whether it's income disparity, student loans, or state-specific rules, a CPA ensures you're not leaving money on the table. For Sarah and Mike, that $1,800 mistake was just the beginning of what they could save with the right guidance. The inheritance impact. That inheritance check you just received, it probably felt like a blessing until the hidden tax traps started to surface. Many people celebrating their windfall don't realize how much the IRS wants a piece of it. On average, that's about $12,000. And while TurboTax might handle simple W-2 income, it's not equipped to navigate the complexities of inheritance taxes. That's where professional help becomes critical to protecting what you've inherited. Let's start with retirement accounts, one of the biggest tax pitfalls. If you inherit a traditional IRA, every dollar you withdraw is taxed as ordinary income. Under the Secure Act, most non-spouse beneficiaries must empty these accounts within 10 years. Withdrawing $100,000 all at once could push you into the 32% tax bracket, costing you thousands more than necessary. A CPA can help you spread withdrawals strategically, potentially saving you $10,000 or more in taxes. Inherited property comes with its own challenges. While you benefit from a step-up in basis, which resets the property's value to its date of death value. Proving this to the IRS can be tricky. TurboTax might calculate the gain when you sell, but it won't help you gather the necessary documentation, like appraisals or death certificates, to defend that stepped-up basis. A CPA ensures you're not taxed on decades of appreciation that aren't yours. Stocks follow similar rules. The step-up in basis applies here too, but only if properly documented. TurboTax might incorrectly use the deceased's original cost basis, which could double or triple your capital gains tax. A CPA verifies the correct basis before you sell, avoiding costly mistakes. State-level taxes are another minefield. While the federal estate tax exemption is high, $13.61 million per person in 2024, states like Massachusetts and Oregon have much lower thresholds, starting at $2 million and $1 million, respectively. TurboTax often overlooks these state-specific obligations, but a CPA ensures you're not blindsided by a six-figure bill. Trust income adds even more complexity. If you inherit through a trust, you might receive K-1 forms instead of 1099s. TurboTax often miscategorizes trust distributions as taxable income when they're actually tax-free principal payments. A CPA reviews the trust documents to determine what's truly taxable, saving beneficiaries an average of $7,000 in incorrect payments. Life insurance proceeds are generally tax-free, but there's a catch. If the policy was owned by someone else, like Uncle Joe, it could be taxable income to you. TurboTax doesn't ask this critical question, but a CPA reviews ownership details to prevent expensive oversights. Family businesses and charitable donations also require careful handling. Inheriting a share of a family company might trigger income in respect of a decedent taxes, which TurboTax can't calculate accurately. A CPA can identify installment payment options to spread the tax burden over time. Similarly, if you plan to donate part of your inheritance to charity, a CPA can suggest strategies like donor-advised funds to maximize your deduction and offset high-income years. Finally, timing is everything. Some tax elections must be made within 9 months of death, and TurboTax won't alert you to these deadlines. A CPA ensures you don't miss critical windows that could cost you thousands. When it comes to inheritance, the stakes are high, and professional guidance can make all the difference. The retirement reckoning. Retirement changes everything about your taxes, yet most retirees keep using the same filing methods they did during their working years. That $2,400 average overpayment? It comes straight from not adjusting to new rules around retirement account withdrawals. Here's what changes when you retire, and why sticking with TurboTax could cost you thousands. Take required minimum distributions, RMDs, for example. Once you turn 73, the IRS mandates withdrawals from traditional IRAs and 401(k)s. If you withdraw too little, you'll face a 25% penalty on the shortfall. One couple learned this the hard way when they missed their $42,000 RMD and were hit with a $10,500 fine, something a CPA could have easily prevented. Beyond penalties, RMDs can trigger ripple effects, like making your Social Security taxable, increasing Medicare premiums, or pushing you into a higher tax bracket. A CPA models these impacts in advance, helping you avoid costly surprises. The order of withdrawals also plays a critical role. Pulling from taxable accounts first allows tax-deferred accounts to keep growing, but TurboTax won't guide you through this. A CPA, on the other hand, creates a withdrawal roadmap, strategically balancing Roth and traditional accounts to save thousands over time. Social Security taxation is another common pitfall. Up to 85% of your benefits can become taxable if your provisional income crosses certain thresholds. Reducing IRA withdrawals could lower the taxable percentage, but TurboTax won't run these scenarios. A CPA ensures you keep more of your check by optimizing your income streams. Roth conversions are a powerful tool for retirees, especially in low-income years before RMDs begin. Converting traditional IRA funds to Roth accounts can save thousands in the long run, but timing is everything. TurboTax processes conversions, but doesn't predict when they make sense. A CPA identifies the sweet spot, ensuring you fill lower tax brackets efficiently. Multiple income streams, like pensions, Social Security, part-time work, and RMDs, can unexpectedly push retirees into higher tax brackets. Just $100 over a threshold could cost you thousands in additional taxes. TurboTax calculates the damage after the fact, but a CPA helps you adjust withdrawals to stay under those limits. Healthcare costs add another layer of complexity. Medical expenses over 7.5% of your AGI are deductible, but RMDs increase your AGI, making it harder to qualify. A CPA might suggest timing major procedures to maximize deductions, something TurboTax won't consider. State taxes also vary widely. Some states tax Social Security, others don't, and 9 states have no income tax at all. TurboTax applies your home state's rules, but won't advise on relocation opportunities. For instance, moving from California to Nevada could save $15,000 annually on a $100,000 retirement income. One retiree, Susan, shared how her CPA saved her thousands by identifying overlooked opportunities. "I had no idea my RMDs were pushing me into a higher bracket," she said. "My CPA restructured my withdrawals and even suggested a Roth conversion plan. I'm now saving over $5,000 a year." The tax torpedo is another hidden danger. As income rises, Social Security benefits become taxable at higher effective rates. TurboTax shows the damage after it's done, but a CPA smooths out income streams to avoid this trap. Finally, qualified charitable distributions, QCDs, offer hidden savings. After age 70 and a half, you can donate up to $100,000 directly from your IRA to charity tax-free, satisfying RMD requirements in the process. This move can save $22,000 in taxes on a $100,000 donation for someone in the 22% bracket. Something a CPA ensures you don't overlook. Retirement taxes are a maze, but with the right guidance, you can navigate it successfully. A CPA doesn't just file your taxes, they create a strategy to protect your hard-earned savings. The future-proof strategy. Most people treat their taxes like a last-minute homework assignment, scrambling every April to report what already happened. But what if you could flip the script? The average taxpayer loses $4,100 over a decade by reacting instead of planning ahead. Here's how to build a financial fortress that grows with your money instead of holding it back. The biggest mistake is treating taxes as an annual event rather than an ongoing strategy. Think of your finances like a growing business. You wouldn't wait until year-end to review your numbers. The IRS gives you 365 days to optimize, yet most people only focus on April 15th. That reactive approach is why 73% of taxpayers leave money on the table through missed deductions and poor timing. Start with the 5-year framework smart taxpayers use. Year 1. Map your current situation. Income streams, assets, deductions. Year 2. Identify upcoming changes, promotions, home purchases, retirement plans. Years 3 to 4. Implement strategies like Roth conversions or charitable giving accounts. Year 5. Adjust for new tax laws and life changes. This cyclical planning helps smooth out tax bumps before they happen, creating a system that protects your financial future. Certain milestones should trigger automatic tax check-ins. Hitting $100,000 income? That's when itemizing often beats standard deductions. Having a baby? The child tax credit changes your entire withholding math. Buying rental property? Depreciation strategies need professional input. These life events are tax pivot points that require system upgrades to keep your plan strong. Roth conversions are a prime example of proactive planning. TurboTax calculates the tax you owe after converting, but it won't tell you to convert $30,000 in a low-income year to avoid paying 24% later. A CPA identifies these windows of opportunity. For instance, someone making $45,000 could convert up to the 12% bracket limit, $49,600, and save 12% on every dollar above that threshold in the future. Investment accounts need annual tune-ups too. Tax loss harvesting isn't just for December. Spotting losing positions throughout the year lets you offset gains as they occur. TurboTax reacts to your 1099s. A CPA helps strategically realize losses when they provide maximum benefit. Even small moves like this can save $1,000 plus annually in capital gains taxes. The phase-out game is where planning pays off big. Many credits and deductions disappear as income rises, like the $2,000 child tax credit, phasing out at $400,000 for married filers. Smart taxpayers park just below these cliffs using retirement contributions or HSA deductions. TurboTax shows where you landed. A CPA helps you steer there intentionally. Estate planning shouldn't wait until retirement. The $13.99 million lifetime exemption sounds huge, but sunset provisions could have it in 2026. Annual gifting, $19,000 per recipient in 2025, and irrevocable trusts take years to implement properly. TurboTax tracks current gifts, but can't project how today's moves affect future estate taxes. Business owners face even more moving parts. That $50,000 equipment purchase could be 100% deductible this year or depreciated over 5. The right choice depends on future income projections. TurboTax applies the rules, but won't model which method saves more over time. A CPA runs both scenarios against your growth plans. Tax brackets themselves are planning tools. The jump from 24% to 32% starts at $201,050 for married filers. Earning $200,000, that last $950 could cost an extra 8% on everything above it. TurboTax calculates the damage. A CPA helps avoid it through timing bonuses or deferring income. The key to building your financial fortress is flexibility. That means 1. Annual check-ins with a tax pro. 2. Modular accounts, Roth, HSA, taxable, you can tap strategically. 3. Withholding adjustments after major life changes. 4. Documentation systems that grow with your complexity. 5. Professional relationships that evolve with your needs. Here's the truth. There's no single best way to file your taxes. What works for your neighbor might cost you thousands. But now you've got the tools to pick what's right for your situation. Take the quiz in the description. It'll give you a personalized recommendation in under 60 seconds. Don't let outdated habits drain your wallet. Your finances change every year, and your tax strategy should too. Ready to take control and keep more of your hard-earned money? Take the quiz now and start